Welcome to this video today. What I want to do in this video is look at one of the great traders, Bill Lipschutz, who's interviewed in the book The New Market Wizards by Jack Schwager. And at the time, Schwager was interviewing all the greatest traders around. Bill Lipschutz was a guy who was responsible for building Salomond's foreign exchange department from scratch into a major player in global FX. Until the interview was made, Bill Lipschutz had been quite secretive and hadn't really revealed much about his trading. And in the interview, I think you can get some great tips and advice from Bill Lipschutz on how to improve a trading strategy. And one of the first points I want to pick out from the interview is where Bill Lipschutz talks about how to make money in Forex and the percentage of winning trades. He actually says, if you want to make money trading Forex, you need to work out how you're going to do it, just winning 20 to 30% of your trades. Now, a lot of traders who come into Forex could learn from that, because they come in believing they're going to make 60, 70, 90% of their trades and get them right. And this is a myth that's put around online. The best Forex traders probably only win half their trades or even less, as Bill Lipschutz said. And the actual amount of trades you win on is irrelevant in Forex trading. It's the difference between winners and losers that matters. You can win on 20 to 30% of your trades, but if your winners are far bigger, you can make dollar profits on your account and lose the majority of your trades. And I think that is something particularly newcomers can learn from. And Bill Lipschutz also makes the point that the best trades are the longer term trades, and I've always said this is true, and I think most experienced traders would. Scalping and day trading, it's a loser's game, and I know there's a lot of hype about it. The majority of traders lose when they come to day trade. Look for the bigger trends, lock into them, because you're going to need them to cover your losses. He also makes the point in the interview that you need to have commitment to Forex trading, which might sound kind of obvious, but he's talking about mental commitment. It's like he says, it's not to do with the hours that you work, it's your mental focus and commitment to the job. And it's one of those things, I think, when you trade Forex, you have to be very sharp in your mind, and you need to have a very clear head. And I think that's what he's trying to basically say. And he also, comes up with the point that you need courage. And you do need courage in Forex trading. He makes the point that, a lot of traders think it's just, follow this rule, follow that rule, that's all you do. Well, it isn't actually. You've got to make the trade, you've got to put on the size, you've got to hold the trade, which requires courage, commitment, and discipline. And he makes a very valid point, I think, in terms of the risks and how to manage them in Forex trading. And basically, he talks about correlation. Don't have too many pairs correlated in the same area that can go against you. But what I liked best about his risk management, and when I first read the book, I took this tip and I still use it today, is to scale in and scale out of trades. So, for example, if you see a market break up and it looks like it's gone again, gone too far too quickly for you, and you don't want to miss out on the move just in case it does carry on, but you don't want to have too much risk. He would scale into that trade, so he'd put a small position on. If it runs on, he'll catch some of it. If it comes back, he'll basically scale in and then scale up the position. And also, he would do this to get out of trade. So let's say, for example, you've got a big profit, you think there's going to be a reversal coming, but you think the trend is going to go your way longer term. He would take 50%, the trade runs on, that's fine. If it comes back, then the other 50% goes in. So the scaling in and scaling out of trades, I think, is extremely useful for risk control. I always have a tendency to do 50-50. So, when a market's overbought, take 50% out, try and catch it on the dip. So I think, scaling in and scaling out is probably one of the best risk control tools you can use. And on another note, I've always been very anti-pyramiding, and I could see no logic in that at all. If you want a way of getting in and out of markets, try scaling rather than pyramiding. I think the overall sort of impression you get of the guy when you read the interview is obviously highly intelligent guy. But when he actually started the currency trading at Salomon, he had no experience of doing it. He had experience in other areas, but Salomon had the ethos of basically promoting people from within. So they were traders. They were just pushed in to do currency trading, and then off they went. They learned as they went along. And I suppose there is no better learning experience than practical experience. And you're obviously a very smart guy. Is he the greatest currency trader of all time? That's obviously open to debate. There's plenty of great traders out there. But you'd certainly say that he would be one of the best. And certainly in terms of tips and advice, I think those few tips I've given you, which I think are the most important from the article, are useful advice for any trader. And I'd strongly recommend that you go and read the book New Market Wizards, and of course Market Wizards by Jack Schwager. Two great books. They're packed with info from true great traders, and I think we can all learn from the very best. So thank you very much for watching me. Take care. Have a good day.